This is Logan Freeman with Midwest CRE Advisors discussing the return on equity trap, why a great California rental is actually holding investors back. Midwest CRE Advisors is a fully tech-enabled commercial real estate brokerage, layering artificial intelligence into every system and process with precision so our team can operate more efficiently and execute for clients in a way that hasn't been seen in the industry before. We utilize a two-phased spotlight strategy to generate 30 to 50,000 targeted impressions for every project we take to market. We don't just list real estate, we launch it. Today's episode is part of our Deal Spotlight series, where we take real numbers, real scenarios, and real investor decisions and break them down the way capital actually thinks about them. And today's spotlight is a trap that I see sophisticated investors fall into all the time. The return on equity trap. Let me paint the picture. This investor owns a California single-family rental. On the surface, it looks phenomenal. $7,750 a month in rent. Ultra low, 2.25% fixed mortgage. After property management and debt service, they're clearing roughly $4,100 a month. That's almost $50,000 a year in cash flow. Most people stop right there and say, why would I ever sell this? But that's the wrong question. The right question is, what is that cash flow actually earning on the equity tied up in the property? According to the analysis, this investor has roughly $1 million of equity locked in this house. When you divide $50,000 of annual cash flow by $1 million of equity, you get a return on equity of just under 5%. That's the trap. This is where mindset matters. Great assets can still be poor capital allocators. This house did exactly what it was supposed to do. It appreciated. It locked in cheap debt. It protected capital. But now the equity has outgrown the asset. The money is working harder for the property than the property is working for the investor. Now let's walk through the alternatives, because this is where strategy shows up. Option one is what most people consider first, cash out refinance. But that destroys the golden 2.25% mortgage and replaces it with 6+% debt. Monthly payments jump. Cash flow gets crushed. That option is almost always a non-starter in today's rate environment. Option two is a HELOC, or second mortgage. That keeps the cheap first loan intact, but layers on expensive variable rate debt. According to the model, if the investor pulls $500,000 via HELOC at 8%, interest only, their original property's net cash flow drops to under $10,000 a year. Then they redeploy the HELOC proceeds into a small multifamily deal. When you combine everything, their total return on equity drops to about 2.8%. They took a 5% return on equity problem and made it worse. Now let's talk about the move that actually resets the board, a 1031 exchange. Instead of stacking debt on top of an overgrown asset, the investor sells the house and exchanges the full $1 million of equity into commercial real estate. At 75% loan to value, that gives them purchasing power of roughly $4 million. At a 7% cap rate, that asset generates about $280,000 of NOI. After debt service, the investor clears approximately $78,000 a year. That's a 7.86% return on equity. Same equity, better deployment. But here's where it gets interesting. That 7+% return on equity is not the ceiling. That's the baseline. Because when you apply agency debt, value add execution, or simply buy at a higher cap rate, the math changes dramatically. The sensitivity analysis shows that at an 8% cap rate, that same $1 million of equity can generate nearly $119,000 per year in cash flow. That's an 11.86% return on equity. That's more than double the return of holding the California house. And that's before rent growth, before depreciation, before cost segregation, before income-driven appreciation. This is the core lesson of today's Deal Spotlight. Real estate investing is not about loving the asset. It's about respecting the capital. The California house is not a bad investment. It's just no longer the best use of $1 million. And sophisticated investors don't ask, is this a good property? They ask, is this the best place for my equity to live right now? Now let's talk risk, because smarter returns always come with different responsibilities. Multifamily requires management. Market selection matters. Leverage amplifies outcomes both ways. Liquidity is lower than single family, but here's the trade off. You're exchanging concentration risk for diversification. One tenant for dozens, one roof for many, one income stream for multiple. And most importantly, you're moving from appreciation driven returns to income driven returns. Income is what institutions pay for. So here's the deal spotlight takeaway. If you're sitting on a highly appreciated residential asset with great cash flow, don't confuse comfort with performance. Run the return on equity math, not just what the property makes, but what your equity makes. Because equity that isn't redeployed intentionally becomes lazy. And lazy equity is expensive. If you want us to model this exact analysis for your portfolio, your house, your small multifamily, your retail asset, or your 1031 exchange options, reach out. You can call or text me directly at 573-694-9669. You can email me at logan@mwcreadvisors.com or visit us online at mwcreadvisors.com.